Well, I think the muni market's in pretty good shape for 2023. You've got a carry yield that we're forecasting for intermediate portfolios of somewhere between 2.4 and 2.7%, Kelly. So, that's a level we haven't seen in 3 or 4 years. So I think we're starting from a pretty good yield, a pretty good base. And when you taxable equivalent that for high tax states, that's upwards about 5.5%. So I think the muni market has set itself up for a pretty good year in 23.
Yeah, Dom, this is an area as well where maybe, we should talk about the difference between owning funds versus owning the bonds outright. If you own it outright, the only real risk you're talking about is default risk by a lot of state and local governments.
Sure. And the thing about it these days, too, is it used to be if you were a muni investor, you had a lot of different investment advisors who specialized in picking individual funds and putting portfolios together. The problem is oftentimes you needed a lot of money, tens of thousands of dollars at least, to be able to kind of put portfolios together like that. With the advent of mutual funds and ETFs targeting specifically those muni funds, you've taken a lot of those minimum concerns away. So you just got to focus on whether or not you are going to be buying the certain types of funds you want. But I would also say that for many of these, people still want to hire managers, either at the mutual fund exchange traded level or even investment advisors themselves, because oftentimes it comes down to picking. And then which ones, by the way, which states, and do you want general obligation based on taxing authority or the revenue bonds based on things like stadium sales or anything else? I mean, those things are all complicated still.
All right, Jeff, you're our expert. Where would you put people's money?
Well, Appleton's a separate account manager, so each portfolio is individually managed. So then you have mutual funds and ETFs, but the massive outflows this year in mutual bond funds to the tune of 120 billion. Interestingly, that money, a lot of it went back into ETFs. ETFs are actually up 24 billion in AUM this year. So
Muni ETFs?
Muni ETFs have seen 24 billion in inflows this year. And I think, Kelly, a lot of that is really the tax loss harvesting that investors did in mutual funds by selling the fund, capturing the loss, and then redeploying it in ETFs. For SMA managers like Appleton Partners, where we're managing the individual portfolio and buying the bonds, directly, we have a little more control over that tax loss harvesting activity, and we've been really busy at that this year.
I guess, Dom, the main concern, so you have Fed rate high. Let's put it this way. At some level, higher interest rates would still be a headwind for muni performance. But inflation itself, like we talked about the other day, can be a problem if you feel like they're just not keeping up and being a good steward of your money over that period of time.
And it's not just that, Kelly. Those are excellent points. It's also about whether or not you look at the way that you have a view on tax policy going forward, either at the state, local, or even at the federal level, and whether or not you want to start building portfolios that take advantage of kind of those tax situations now, and not just the tax loss harvesting, but this kind of secular view on where you think taxes will be, and if you want some of that tax-free income, if you believe taxes are going higher in the coming years. But also, an interesting point coming up for Jeff, some of those dislocations have created opportunities in certain parts of the muni market tied to closed-end funds. I know that some investment advisors I speak to are looking, trading at discounts to where net asset value is. So some of those trading anomalies might be setting at least some investors up to look towards other parts of the market besides the outright bonds or even just straight ETFs.
So, Jeff, we'll give you the final word here. What do you think are the best opportunities across muni land right now?
Right now, I like the longer intermediate part of the curve. There's still some steepness left there. Call it 10 to 15 years. You keep your duration in check. So if you do see higher rates in 2023, you're going to be in better shape. The other thing, I think, when you're owning the individual bonds and municipals in high grade, investment grade, the default rate is 0.1%. So a good manager that's dealing in investment grade bonds can build a highly effective municipal portfolio that delivers good tax-free income and preservation of capital, and that's what investors want. And
we know that after this year, Dom, people are looking and saying, man, maybe there's some good value there. Maybe it's, they're not so boring, are they?
Are you saying there is an alternative?
Yeah, exactly. Jeff, thank you so much for your time today. We appreciate it.